My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to help you save some money. My job is not just entertain, but to put days like today into context, because it is needed. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Wall Street, it looks like it's had it with the mega caps, doesn't it? We don't want to hear about the Magnificent Seven anymore. Everyone thinks these stocks have gone to unsustainable levels so that they want to lock in gains and pivot to groups that have room to play catch-up, like the small caps. That's what's driving this vicious rotation we've seen over the past few weeks. Although today we mostly experienced the negative side of that move. The house of pain. Dow tumbling 504 points, S&P plummeting 2.31%, but the tech-laden NASDAQ plunging 3.64%. Oh, they crushed tech they once loved as they slammed the door behind them. The approximate cause of today's sell-off, the allegedly weak results from Alphabet, parent of Google, and Tesla. I say allegedly because Alphabet actually had an excellent quarter, and while Tesla missed the earnings estimates, Elon Musk told a great story of self-driving technology, sorely needed energy production, not to mention humanoid robots. I'll have more on that later in the show. If not for the rotation out of big tech, I know this sounds like a stretch, but you have to understand, I think both these stocks would have been up today, especially Alphabet, which put up phenomenal search numbers, incredible results from Google Cloud. With $10 billion in sales this quarter, didn't think it was possible. There's some hair on the YouTube results, but that had more to do with tough comparisons versus last year, with Temu and Shein, Chinese companies, flooding the streaming zone with ads last year. If you think of YouTube as the #1 streaming platform, which we know Netflix talked about in its conference call, then you know that the results are pretty darn good. Let's stop kidding ourselves. It's a rotation. But the stock was up 30% for the year going into the quarter, and a highly visible division seemed to underperform. Seemed to. Hence today's 5% pullback, and it was ugly. Similarly, Tesla got crushed, down more than 12% today, because it didn't run so much in the quarter. But even though I thought everybody knew the quarter itself would be weak. No, everybody did. That's not the point. It's hard to hold on to those gains after a big run from the 170s during rotation out of big tech, of which Tesla is most certainly now big tech and not auto. So there you have it, the chipper and the shredder of today's market. Now, even though there's a rotation going on, you may not see the big cap money donated to the small caps on the same day. A day of ugliness like this might spare almost nothing, save a couple of large cap healthcare stocks. They can't all be like the day that started this rotation, where after a very soft June consumer price index number, the NASDAQ fell almost 2%, while the Russell 2000 small cap index jumped 3.6%. Look at that disparity, huh? The always brilliant Michael Semblis, the chairman of market and investment strategy at J.P. Morgan, pointed out that day saw the single biggest outperformance by small caps in over 30 years. Talk about a bell going off. Since then, we've seen the mega caps act terribly and the small caps act better. Of course, Semblis reminds us that the small caps are a very small part of the market. They haven't performed as well as the big caps over time because, frankly, they aren't as good as the big caps. Large cap tech has tripled the performance of small cap tech since December 2010, and most of those gains have come since 2019. Now, during this period, we've seen great. Let's start with FANG. Facebook, now Meta, Amazon, Netflix, and Google, now Alphabet. And then to the Magnificent Seven, which changed out Netflix and added Microsoft, NVIDIA, and Apple, all of which have been acting really miserably. I mean, geez, Netflix. I mean, that was such a great quarter, it didn't matter. NVIDIA, I think, doesn't matter. Amazon, they could have a good quarter, it won't matter. Not in this tape. No, it won't matter at all. So get used to what happened today. Is there anything that can explain the disparity between small cap and big cap? First, small caps are much cheaper in all sorts of valuation metrics, including the all-important price-to-earnings ratio. But there was a moment when Donald Trump looked like he had the election in the bag, and he favors heavy tariffs pretty much everywhere, which means the estimates may be too high for the big companies that import goods and do huge business overseas. Trump has also expressed a lukewarm allegiance to some allies, including Taiwan, which he believes stole our semiconductor manufacturing capabilities. So you can see how people would want to swap out of large cap tech and large cap multinationals and swap into domestic small caps. Although now the Democrats have rallied around Vice President Harris, well, maybe that trade won't be such a slam dunk. Finally, there's a growing revulsion toward artificial intelligence and the idea that it can produce big profits after investing billions of dollars. Both Alphabet and Tesla talked about massive spending on data centers, how much they need to do, with much of that going to NVIDIA's chips. Most of the companies that are in the Magnificent Seven are spending like mad on these things. And since the whole group is linked together by ETS, if you take down Tesla and you take down Alphabet, then the other 5 all get crushed. But what are you buying in the rotation? Tricky question. Last week, let's walk the street. I went over some of the top 10 winners in the Russell 2000. They were a motley crew of already extended small caps that are losing a lot of money. It didn't seem like awful things to buy. This time, I'm changing things up. And for our show, focusing on the 10 largest S&P 600 stocks by market cap that would be in the S&P Small Cap Index. This is what people are going toward. These stocks have already been huge beneficiaries of the rotation, but they might have more upside because they've underperformed so badly over the years. So let's talk about playing catch up and what it means. I'm going to give you the top 10 of the larger ones, okay? First is Fabrinet, which offers an outsourced manufacturing service for optical and electrical mechanical devices. Stock sells at 26 times earnings, but it's now given up the gains it made after the July 11th CPI reading, and then some. Makes sense. This is an outsourcing play, and the whole rotation is about the end of outsourcing. Next is ATI, the old Allegheny Technologies. It's the best specialty steel company on earth, including stainless and tungsten. ATI has gone from 57 to 60, and it sells for 24 times earnings. Much of it still goes into aerospace. I really like it. That's a small cap you want. Third is Ensign Group. This is a company that does nursing and rehab, sells at 25 times earnings. It's gone from 130 to 136. This one works, too. Fourth is SBS Commerce, which offers supply chain solutions. A true enterprise software play, sells for 61 times earnings after rallying from 189 to 205. No thanks. Fifth is Mueller. I know this. I remember when it was spun off from an old steel company in the 1990s. Mueller's an old-fashioned metal bender, which makes aluminum and copper forgings cheap. 14 times earnings, even though it's gone from 57 to 65. I like it a lot. Six is Insight Enterprises. Works with information technology and assembled devices, including those involving AI. Trades at 20 times earnings. It's already jumped from 196 to 217. I can't play. Seventh, Meritage Homes, good old home builder. It sells for 9 times earnings. After seeing its stock surge from 163 to 196, move too much. I prefer Toll. Eighth is a classic industrial, SPX Tech, which specializes in heating, ventilation, air conditioning. Trades at 28 times earnings, although the stock's unchanged since the rally began after getting hit hard last week. No thanks. I will take Carrier. Ninth, there's Installed Buildings, which installs residential insulation, garage doors, shower doors, and gutters. 21 times earnings, jumped from 221 to 248. I still like it. Finally, there's Comerica, considered by many to be the worst mid-sized bank in the country. Sells for only 10 times earnings, sports a 5.4% yield. That stock's unchanged since the small cap rally began because why? It reported a very weak quarter. You don't want it. These are very representative, though, of what the S&P 600 gives you. It's what everyone says when they say they're rotating a small cap. You just got the list. I want to point out that while many have run, some were left behind, yet most of them aren't that expensive. But maybe the particulars don't matter because big institutions just sell the Magnificent Seven, then buy the whole S&P 600 basket put together by brokers, even as one of the 7 is better than any of these 10. Let me give you the bottom line here. After today, many of the Mag 7 have gotten hammered so badly that they're actually cheaper than almost all the small cap stocks I just gave you on a price earnings basis. Then again, until we work through this brutal rotation, that newfound cheapness probably won't be enough to save the big caps. Only lower prices will accomplish that. Ouch. Mark in Iowa. Mark.
Good evening, Jim. How are you today?
I don't know. A little rattled here, Mark. A lot of my favorite stocks got crushed today when some really lousy stocks went up. So it's kind of upsetting me. What's happening?
Yeah, there were a lot of brown shoots, weren't there?
Yeah, that's exactly the problem. Lots of brown shoots. Why healthcare went up, too. Man, you are on the case, Mark, in Iowa. How can I help you?
Well, Jim, I'm seeing the story change for a company in the not well-liked EV space. They're entering into a partnership with an OEM company that will provide them with billions of dollars to further develop their EV software. Also in the deal, they will share their advanced electrical engineering expertise with that company. The partnership will lead to lower vehicle cost and faster advancements. Both companies will share many technologies, but will produce their own vehicles. with some time, how will this deal with VW change the Rivian story?
I think it takes off the existential problem of them going under. It doesn't necessarily make the stock a great price, but I agree with you. I think Rivian, if you wanted to buy 100 shares, you can buy 50 right here and then buy 50 down $2. After today's rout, most of the Magnificent Seven is actually cheaper than the small cap winners that I just wrote about and told you about. But until we work through this rotation, being cheap probably won't be enough to save them for now. Man, buddy, tonight, cloud juggernauts Salesforce and Workday are teaming up to create a new AI employee service agent to demystify the world of HR and finance, and also, I think, take on ServiceNow, frankly. I'm hearing how this new strategic partnership could be the key to the future of AI in the enterprise. Interesting. Then Thermo Fisher, TMO, struggling to find growth after big years in 2020 and 2021. So what is it going to take this to return to its former state? I'm talking to the company's top brass. Feels a lot like Danaher yesterday, doesn't it? And Boston Scientific hit an all-time high before pulling back today after a beat and raise quarter. The expectation is just too high of running into the quarter. I'm going to get to the bottom with the CEO. Man, do I ever like that story, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.